Let me tell you something that sounds controversial but is actually true. Most of the technical analysis you have learned so far is basically useless. Indicators, pattern names, complicated multi-step strategies, all of it. If I give a beginner trader a chart with 50 indicators on it and another chart with nothing but price, the beginner with nothing will actually make better decisions most of the time. Because indicators give you information that is already in the price. You just need to learn how to see the price properly. Here is what I have learned over 8 years of prop firm trading and over $2 million in payouts. You do not need 50 different tools to read a chart. You need just 3 simple concepts. That's it, 3. And once you understand how they work together, every chart on every market on every time frame starts to look like the same game. I'm going to show you these 3 simple concepts: market structure, liquidity, and fair value gaps. And I want to be very clear, these are not my concepts. These are not something new. They have been around forever. What I am going to show you is how they actually work together, because most educators teach them separately and miss the part that actually matters. Now, these 3 concepts apply to any market: the forex market, the crypto market, futures, and stocks. Any time frame, 1 minute chart or weekly chart. The game is identical. 5 layers today. 3 concepts explained one at a time, then how they combine, then the one single rule I have never broken in 8 years of trading. So let's get into it. Layer 1 is market structure, and this is the foundation of everything else. Market structure at its core is just the pattern of highs and lows. That is it. You are looking at a chart and asking one question: are we making higher highs and higher lows, or are we making lower highs and lower lows? Higher highs and higher lows means the market is in an uptrend. Buyers are in control, every pullback is being bought. You should be looking for long setups during that environment, and you should be very skeptical of shorts. Lower highs and lower lows means downtrend. Sellers in control, rallies are being sold, you are looking for shorts and being skeptical of longs. This sounds stupid simple, right? Because it actually is. But most traders forget this when they are in a live trade. They see a setup forming and they just take it. They do not stop and ask which direction the structure actually favors. And that is why they lose. The most important concept inside market structure is a break of structure. This is when price moves past a significant swing point. For example, if we are in an uptrend making higher highs and higher lows, and then the price suddenly drops and breaks below the last significant low, that is a break of structure. The trend just shifted, the uptrend is no longer valid until price makes a new higher high. But here's a rule that most people get wrong, and this is the one thing I want you to take from this entire section. Higher time frame structure always beats lower time frame structure. What that means practically is this: if the daily chart is in a clear uptrend, but the 5-minute chart shows a break of structure to the downside, that is not a trend shift. That is just normal retracement on the 5-minute time frame while the daily trend continues. You would be completely wrong to short that 5-minute break of structure when the daily is saying long. The way I trade is always aligned with the highest time frame I can find a clean structure on. If the daily is bullish, I look for longs on the lower time frames. I'm not going to short just because the 5-minute looked bearish for an hour. That alignment is what keeps you on the right side of the big moves instead of getting chopped up trying to take a counter trend trade. Now, layer 2 is liquidity. And this is the concept that will change how you see every chart once it actually clicks. Liquidity is basically just a fancy word for stops, specifically the stop losses of other traders in the market. When you think about a market, every chart you look at has thousands of traders with stop losses sitting somewhere. Those stops are not just random, they cluster in very specific places. And price is constantly being drawn towards those clusters because when enough stops get hit at once, it creates the volume needed for bigger moves. This is why price does what it does. It is not magic. It is not random. Price is moving from one pool of liquidity to another pool of liquidity. That is the whole game. Let me show you the specific places where liquidity sits, because this is what you need to be marking on your charts. First place, previous day high and previous day low. Every trader who traded yesterday has stopped somewhere around those levels. Break yesterday's high and a wave of short stops get triggered. That creates buying pressure. Then price usually reverses because the liquidity has just been taken. Second place is the Asian session high and Asian session low. For traders in the European and New York sessions, the Asian range is one of the most important level, because traders who took positions during Asia have stops just outside the range. When London opens and breaks one side of the range, those stops fire. It's the same exact mechanic. Third place is the session opening ranges. The first 30 minutes of a session usually establishes a range. Once that range breaks, the stops outside it get swept. These three types of liquidity are what I reference the most. Mark them on your chart always, every single session, because price moves toward them before it does everything else. Now here's the rule for liquidity. When price sweeps a liquidity level, meaning it spikes through the level with a wick and then reverses quickly, that is not a signal to enter in the direction of the sweep. That is a signal to enter in the opposite direction, because the stops have already been taken. The fuel for the move is gone. Smart money was the one hitting those stops, and they now want price to go the other way. If you remember nothing else about liquidity, remember this. The sweep is the end of a move, not the start of one. Now layer 3 is fair value gaps. This is the most specific of the three concepts, and it gives you the actual entry point. A fair value gap is an imbalance on the chart. It happens when price moves so fast in one direction that trading did not happen at certain levels. You see it usually as three candles where the high of the first candle and the low of the third candle do not overlap. There is a gap between them. That gap right there is called the fair value gap or the imbalance. Why does this matter? Because the market does not like these gaps. They represent inefficiency, and eventually price comes back to fill them. This is a pattern you see on every market, every time frame, constantly. So how do you actually trade this? There are two ways people use fair value gaps, and only one of them is correct in my experience. The wrong way is entering the moment price reaches the fair value gap, setting a limit order at the edge of the gap and hoping it bounces. This gets you filled on setups that are not clean, and you end up with trades that go against you immediately. The right way for it is waiting for the reaction at the fair value gap before actually entering. That is what I do. Price reaches the fair value gap and I wait to see what happens. If price pushes into the gap and forms some kind of reaction, a rejection candle, a smaller structure shift on the lower time frame, any confirmation that buyers or sellers are defending the level, then I enter the trade. The difference between those two approaches is huge. Limit order into the gap means you are guessing. Waiting for reaction means you are reacting to what the market is actually doing. One of them is prediction and the other one is confirmation. Always choose confirmation. For me personally, I wait for reaction every time. No limit orders in the gap, no entries without confirmation. That extra patience will cost you a few trades where price just bounces without you, but it saves you from dozens of trades where price just slices through the gap and keeps going against you. Now layer 4, and this is where most educators fail, right? They teach these three concepts separately, but they do not show you how they actually combine into a full trading setup. Here's how all three of them work together in a real setup. You start with the highest time frame you can find clean structure on. Let's say the daily time frame. Daily is in an uptrend. Higher highs, higher lows, so your bias is long. You are only looking for long setups. Next, you identify the liquidity on the chart. Previous day low, sitting below current price. Asian session low, also below. That is sell side liquidity. Stops of long traders who entered on higher time frame structure. You know price is going to target those levels at some point before the uptrend continues. Now you just watch price. Price drops down, it sweeps the previous day low, takes out the stops, and then starts to react. Wicks up, forms a small reversal structure on the 50-minute chart, a break of structure on the lower time frame in the opposite direction of that sweep. You zoom in and you find your entry. There is a fair value gap created during that reversal. Price retraces back into the gap, you wait for the reaction, a rejection candle, another small structure break, and you enter a long position. Higher time frame structure set long, liquidity got swept to the downside, giving you your entry opportunity. A fair value gap gave you the precise entry with stop loss placement right below the low of the sweep. Target is the previous day high, just above. Three concepts, just one setup. This is the exact mental model I run on every single trade. It does not matter what market, does not matter what time frame. The game is always, where is the higher time frame pointing, where is liquidity sitting, where is the fair value gap for entry. Find those three things aligned and you have yourself a trade. When they are not aligned, you do not have a trade. And most traders miss this part. They find one of the three concepts showing something interesting and they take the trade. But without all three of them aligning, you are just guessing. Now layer 5, and this is the rule I have never ever broken in 8 years of trading. Never trade against higher time frame structure, no matter what the lower time frame looks like. And I mean this literally. If the daily is in an uptrend, I do not take a short. ever. Even if the 5-minute chart looks like a perfect bearish setup, even if there is a clear fair value gap to short into, even if liquidity is sitting above that will make it look like an obvious sweep and reverse. Because here is what happens when you trade against higher time frame structure. You might catch a move. It might even work for a while, but eventually the higher time frame wins. It always does. And when it resumes in its original direction, your counter trend trade gets run over. This is the rule that separates consistent traders from the ones who have one great month and then a disaster. The consistent traders never fight the dominant direction. They wait for the setups. And if the higher time frame is pointing the wrong way for a setup, they just skip it, no matter how clean it looks. I have watched so many traders blow up accounts trying to short an uptrend or buy a downtrend because the lower time frame structure looked good. The setup was fine. The problem was they were trading the wrong direction for the bigger picture. 3 concepts: market structure, liquidity, fair value gaps, but all 3 need to align with the higher time frame. Not just one of them, all 3 of them. If they are aligned and pointing in the same direction as the higher time frame, you take the trade. If any single one of them is going against the higher time frame, you skip the trade every time. This one rule alone would save most traders from blowing accounts. Not some fancy risk management setup, not some fancy risk management, not better setup, just this one rule. Do not fight higher time frame structure. So to bring all 5 layers together. Layer 1, market structure. Higher highs and higher lows means up, lower highs and lower lows means down. Higher time frame always beats the lower time frame. That is the foundation for everything. Layer 2 is liquidity. Stops cluster at previous day highs and lows, Asian session high and low, and session opening ranges. Price sweeps these levels before making its real move. The sweep is the end of a move and not the start of it. Layer 3, fair value gaps. A 3-candle imbalance, price returns to fill it, wait for reaction at the gap before entering. Never enter on a limit order into the gap. Layer 4, all 3 of them work together. Higher time frame gives bias, liquidity gives you where price is going first. Fair value gap gives the precise entry. All 3 aligned, you have a trade. Anyone that is misaligned, you just skip it. And layer 5, never trade against the higher time frame structure. Even if the lower time frame looks perfect, higher time frame always wins in the end. That is the entire framework. 3 concepts, 1 alignment rule. It works on every market, every time frame, and has for decades. It will work for decades after this. You do not need more indicators, you do not need more patterns, you do not need a more complex strategy. You need to look at charts using these 3 concepts until they become simple. Until every chart you see looks like the same exact game. 8 years of pro from trading, over $2 million in payouts. This is the only things that I use. 3 concepts, 1 rule, and nothing else. That is what reading a chart actually is. If you want to learn how to actually apply these concepts with real setups and accountability, I have a mentorship program called the Pro Firm Blueprint. For traders who are serious about building the foundation properly, the link is in the description to apply. And if you are looking for a pro firm, I strongly recommend Hola Prime. They have the fastest payouts in the industry and they have just been verified by a third party. You can use the link in the description to get the best discount as well. Thank you guys for watching and I'll see you in the next one.